I love going to weddings, and one common but probably unspoken thought is whether I'm going to get the chicken or the beef when it comes to the mains. The good news for you is I think you can and should have both. And what I wanted to do today was present the case for uncovering really good opportunities in both value and growth segments of the market by focusing on what matters. I also wanted to do something probably that no investment manager has done in the past 6 months, is to deliver a presentation without mentioning coronavirus, starting from now. But to get into today, what I wanted to do was really outline 3 key areas. The first one is that beliefs are being tested. There's so many things going on out there. People are wondering what the future is. Secondly, is that one constant we absolutely do see is that short-termism creates opportunities. And finally, many are debating value versus growth as if it's religion. We strongly believe there's opportunities for both, and we'll highlight 2 of our best ideas in the space right now. So the key point of today is really demonstrating a proven approach to finding opportunities in today's market. The first thing I wanted to say was that beliefs are being tested across the market. The economic swings we're seeing are unprecedented. At the same time, the shift to online is creating winners and losers faster than we've ever seen before. And thirdly, valuations are dispersing massively. If you've got growth in a low rate environment, your share price is off to the races. If you don't have much growth, you're being left behind. So these beliefs are being tested with the current uncertainty, but there are a few things that you can really hang your hat on. The first one is this: every company has a price. It doesn't matter how good that beachfront apartment you buy is, if you overpay for it, it's going to be a bad investment. So every company has a price, recognises that yes, there are good and bad companies, but most importantly, there are good and bad investments, and that comes down to the price you pay. The other thing you can hang your hat on is you can focus on what matters to cut through the noise. Noise is ramping up. With the advent of social media and it taking off exponentially, everyone's got an opinion. Secondly is that with more of these opinions, more information, we're finding a lot more interesting articles, interesting views on companies, but it may not be what matters. And so focusing on what matters allows you to cut through the noise. And then thirdly, you've got to have the flexibility to capture both value and growth opportunities. These value and growth cycles have been shown to last, up to 5 years. And if you just closed off to one of those areas, you won't have as robust performance as you could have with more flexibility. So while there is a lot of uncertainty at the moment and a lot of people are questioning their beliefs, we believe this is a proven approach to investing. So how do we use short-termism to generate ideas? Well, many managers select stocks based on whether they're growth or value. But as I've mentioned, our view is both represent opportunities. So how do you look for them? Well, what you can see here on this chart is really a schematic of where growth stocks trade. They trade at premium valuations to reflect longer term growth. And you've got the value stocks which trade at lower valuations as a proportion of earnings or whatever it may be. So what you do when you want to use short-termism to your advantage and look longer term is you wait for some bad news. The market will typically overreact to bad news and even capitalise it into long-term valuations. And so what we're looking for here is either growth stocks or value stocks that are derated based on a short-term event that isn't going to be long-standing. Once you've got this idea and a framework, you can then go and look at what matters and work out whether that's reasonable or whether it's unreasonable and there's an opportunity there. But the key point here is that the market regularly derates both value and growth companies based on short-term information. So what I wanted to do now was to jump into 2 opportunities we're seeing in the market, both in growth and in value. And the first one is Seek. So Seek is the market leader in Australian job ads and helping employers place candidates into roles. They've got that dominant position in Australia. They've also got market-leading positions in both China and Southeast Asia. It is one of Australia's great growth stories. But more recently, Seek has been derated because of cyclical exposure to job ads. So while they are a growth company, they've done 18% revenue growth CAGR over the last decade, they're still impacted by lower job ads in the short term. And so in our view, this is the opportunity in Seek where growth has been cyclically impacted, and that means an opportunity for investors to look through. The second one, which is more of a value company, is Lendlease. Now, Lendlease is an integrated developer investment manager specialising in real estate. They've got leading positions in Australia, but also in 15 gateway cities around the world, places like New York, San Francisco, Milan, Chicago, and London as well. The D rating for Lendlease has come from engineering. You can see here a tunnel. Engineering was a business that Lendlease bought 10 years ago now for $1 billion. In the past year and a half, this business has lost $1 billion. Contract losses from doing these large-scale, fixed-price projects has meant major losses for shareholders and a very poor performing division. So that's the opportunity where a small division has created a lot of problems for Lendlease. So in both cases, I think if you just step back for a moment, the D rating has been caused in the case of SEEK by cyclical job ads and in Lendlease by an engineering poor performing division. We think the cyclical turnaround can happen. And for Lendlease, interestingly, from when I put these slides together to today, Lendlease has actually sold the majority of their engineering division. And so many of those problems are behind it now. If we step now into what matters, because this is really where the rubber hits the road. For SEEK, what matters is who fills jobs in Australia. You can see in this chart here, of candidates that are placed that don't come from internal referrals, SEEK really is the only game in town, placing more than 30% of candidates in job roles. Many of you may be thinking, but yeah, I spend a lot of time on LinkedIn. You can see here, when it comes to actually placing candidates, SEEK is the dominant player. I think what gets quite interesting once you dig a little bit deeper is that you look at candidates and you put yourself in a recruiter's shoes. So the average or the median wage in Australia is $62,000 a year. If you're a recruiter, you'll take roughly 15% of first year wages as a fee. So $9,300. Now those recruiters are putting job ads on SEEK, and at the moment, you're looking at $64 per job ad. We believe there's a major opportunity for SEEK to close that valuation gap. And when I say valuation gap, the value they're providing to recruiters and SMEs by lifting prices over time. And it may not just be blunt price increases, but it's providing more value, saving HR businesses and recruiters more time by using their data. So the key point here is that SEEK is a market leader with significant upside, particularly on the pricing front. When it comes to Lendlease, what matters for them is that they are the leader in global developments, particularly in residential, office and retail mixed-use precincts. You can see here, this is an artist's impression of a Google project. Lendlease was lucky enough a year ago to win a project to build 15,000 apartments with Google in the San Francisco Bay Area. Those 15,000 apartments have a finished value of $20 billion. This was, a company-changing win in our view, and really speaks to the credentials that Lendlease have as a global developer. But it's not a one-shot, and Lendlease isn't a one-trick pony. You can see here in the next chart just how much this development pipeline has grown over the past 7 years, from less than $40 billion to now more than $100 billion. So this is one of Australia's great global growth stories in waiting, in our view, and over the next few years, we believe cash flows are going to grow tremendously. But then let's look at valuation, because every company does have a price. You can't just buy good news stories and ignore price. You need to take it into account. And so in the case of SEEK, consider this. FY22 EV to sales for selected technology stocks, SEEK's right down there at the bottom. And we believe a lot of that has to do with the cyclical impacts of jobs at the moment. We also support that valuation because this isn't a core metric, but for us, looking at long-term cash flows such as discounted cash flows really speaks to the value on offer in SEEK compared to some of these other high-quality businesses. When we look at Lendlease, we see a lot of growth as that development pipeline matures, but some of that development pipeline is actually going to go into an investment management division. And so today, Lendlease manages less than $40 billion of funds under management. We see a really plausible scenario where Lendlease could be managing over $100 billion of investment management over the coming years. And so I think what's really important here is not only are earnings going to grow, but it's going to grow in higher quality areas with more recurring revenue nature, such as investment management. So Lendlease is shifting towards a higher value recurring earnings model over time. So just let me put those two ideas together for a moment. Both SEEK and Lendlease derated on what we believe are going to be short-term concerns in cyclical job ads and in engineering. You've got what matters, which have highlighted really strong businesses with massive growth potential. And then finally, you've got valuations both in SEEK and in Lendlease, which speak to a lot of upside. So today I set out to really, prosecute the case for investing in value growth and focusing in on what matters to find the opportunities. While a lot of people are questioning their beliefs at the moment, there are proven approaches that are critical to success, and we highlighted some of those. Short-termism will always provide the opportunity. That is the behavioural bias that we see time and time again. And while many are debating value versus growth like it's religion, we absolutely see the opportunity for value and growth. Now, at your next wedding, you probably are going to have to choose between the chicken and the beef. But if you invest in the Firetrail High Conviction Fund, we'll make sure you get the very best value and growth stocks we can possibly find. Thank you.